All right, now this is a question that came in from Khokon this afternoon. Stock is down. Earnings are coming up. How to manage it? Khokon's specific dilemma, specific situation, is he has crowd at 216. It's now trading at 196, down about 20 points, roughly about 9.5, 9.7% or so. How to manage the positions? Earnings are coming up on Tuesday, August 30th, after the market close, and he brings an idea. Should I sell the stock and sell a put out to October? Are there any other ideas? Well, let's take a quick look at Khokon's idea first. We own shares of stock at 216. It's now down to 196. As I started to put the slides together, it fell to 195 and actually fell a little bit before that, down to 140, 94.90, excuse me. So let's just take the 196 to keep it simple. We're at a $20 per share loss on the position. If I sell the stock right now, I realize that $20 loss essentially in my portfolio. So the only October puts I'd want to sell to be able to get back to a break even would have to have a premium of over $20. Now, there's multiple in the money ones, of course, but the first one that offered a more than $20 premium was the October in the money 210 strike put. So if we sold the stock and sold to open the October 210 put with the stock at 196, we'd get $25 in premium. However, this is only going to be a $5 credit, essentially a $5 premium for this cash secured naked put at 210, because we have to factor in the $20 realized loss on the position. So what would happen if we sold the stock and sold this 210 put for the $25 premium? Well, in October, if the stock's still below 210 and it was put to us, we'd have a cost basis of 205 per share. We get put the stock at 210. We keep the $25 premium, but we have to factor in the additional cost basis from the $20 realized loss of selling the stock position. So we'd be back into the stock with a cost of 205 instead of 216. Essentially, we average down, but instead of putting another full block of shares in and buying another 100 or 200 shares at 195, we went this route, waited 60 days, and now have a cost basis of 205 wherever the stock is trading. If the stock moved above 210 and our sold put expired worthless, we'd keep the $5 premium after factoring in the $20 realized loss, and we'd have a 2.4% profit after about 60 days. And that's about 60 days, of course, from today. So is it an approach to use? It's a possibility, but with earnings coming up, what hasn't happened at all? We haven't addressed anything regarding the downside risk. The stock's already here now at 195, 196. We've got a $20 unrealized loss. We sell it, we realize the $20 loss. We have the potential to make 2.4%, but we still have the potential to lose much more if the stock continues to move down in price. Yes, we hedged that with some of the premium by selling this put, going into a cash secured naked put position. But again, we still have the downside risk if the stock continues to fall, if earnings are poor during the unexpected event coming forward. Now, what about something further out of the money? Normally, we wouldn't look to sell an in-the-money put. We'd like to sell out of the money and have it expire worthless. Well, again, if we're selling the stock to sell a put, we have to get at least $20 premium to see any profit. If we don't, then we've sold a naked put or a cash secured put at a debit. So even if the stock stays above our out-of-the-money put that we sold, we're still at a loss. Is it potentially less than a loss of just closing and realizing the 20-point loss on the position we have right now? Yes, but 60 days out to October, keeping in that time frame, 60 days out, we're still looking at a loss, and we just have to keep rolling that naked put potentially in order to manage it. And of course, if earnings are really disastrous and the stock falls to 160, 165, we can still lose more to the downside. But if we did use the out-of-the-money 180 strike for October, 15 points out of the money right now, a little bit less than 10%. liquidate the stock, get $10.85 for the 180 put. The new cost basis, if assigned, the stock was trading below 180, we'd have a cost basis of 180 minus our 1085 premium plus the $20 realized loss. We'd own stock potentially at 189.15, a lower cost basis than we have right now at 216, absolutely. But if the stock continued to fall, then we're still at a loss on the position. If the stock remains above 180, the put would expire worthless, and we've had a loss of 915. We'd have to keep selling those premiums over and over again over time to make that back. Is it less than the $20 loss we have right now? Yes. But there's no potential for profit on the potential position in this case. All right. Now, that's just Khokon's general idea. What are some of the other ideas? Well, what do we have? We have a decline in the position, and earnings are coming up, and we're entering an unknown. What is the outlook for the upcoming event? Do we expect positive earnings from the stock? Khokon bought the stock expecting it to be a good performer, but it's pulled back against him. He's down about $20, just call it about 10%. But earnings are coming up. Do we expect positive earnings based on what's been going on with other stocks in the sector or industry? Do we fear a poor earnings, as some earnings have come out, but different things have happened? I was thrown off the other day when Dollar Tree reported their earnings and were down 15%. Dollar General reported on the same day and they were up 5%. Pretty close to the same companies, but one performed much better than the other did. So I was kind of shocked that they both didn't drop in that case. Or do we just have no idea what to expect in this case? And Khokon does add here that positive earnings like PanW, okay? But we want to walk through all three scenarios to sort of help anyone who might be in this situation. But that's great, Khokon, that you have positive earnings. And of course, what is the plan going forward for this particular situation? Do you plan to keep this as a longer-term holding in the account? You feel confident about it. We've had some rough patches, but you feel it's going to recover and you want this to be a core holding in your account? Do you just want to get break even or have some profit and get out of this position without seeing a loss on it? Or no idea. You bought a stock, you hoped it would go up, it didn't, now you just don't know. Those are things you want to consider before you do any adjustment prior to an earnings or trying to repair a position or anything along those lines. It's sort of what we call the SIGA model in radioactive trading. What are my expectations? What are my goals for the positions? And what are the current market conditions? I should have started with that, CEGA. The current market conditions or conditions on my stock. What are my expectations for the position? What are my goals for the trade? And that's going to determine my actions. The SIGA model, it applies to really all strategies. All right. Now, other ideas. Expect a positive earnings. Well, do nothing. Maybe wait to see what call premiums, just selling a covered call against a position, are available after the positive move on Wednesday. Maybe we get back up to 210, 205, and you can start managing the position even though you have a small loss then. Maybe you get lucky and it shoots up above that as well. Your 216 cost basis, my apologies. You could now just sell an out of the money for some hedge. The 16th September 210 call is about $6. So if the stock does move up above 210 and you get assigned to keep the $6 premium, you're essentially at break even. But then you could consider rolling or adjusting the position. Again, rolling it if you're long term. If you just wanted to get back to break even, let it be assigned on the trade. Or, of course, on power options, you have that tool for a stock repair position. You can use the stock repair, which will build a ratio call spread, buying one lower strike call, selling two higher, usually done at a credit in this case. And if the stock does move back up the lower break-even value, in this case, using the 16th September 192.5, 205 calls, you get a small credit on the position. And if the stock is trading above 205, you'd make 1.4%. You didn't need it to go back to 216. However, of course, gets you back to break even pretty early at around 203.50, 203.60, somewhere around those lines. So you can just get back to break even, get out of the position, and there you are. The stock repair would be used if I just want to get back to break even and it's not a long-term hold. The do nothing idea is more if I'm planning on staying in it and I'm staying on manage it. I think it's going to be positive, so I'm not going to do anything. Or you could sell the out of the money call, which could still be adjusted. That's still if you're planning on holding it long-term, Khokon, or just getting back to break even. If you don't see a good stock repair, you don't see a good call that you can sell right now that's out of the money that might get you back to break even, just going up to 210 instead of 216, then you might want to consider averaging down and then applying any of the income methods above. But you're putting in more capital, and if you're wrong on the direction and the earnings surprise is bad, you're going to be taking more monetary loss on the position. If I'm in this situation and I expected negative earnings, the market's just too tenuous, I've seen other stocks in the industry not meeting their expectations or cutting their outlook going forward and falling 5, 7, 10%. Let's talk about the obvious. Sell the stock. Realize the loss. Avoid any more losses on this position. Try to make it back on other stocks that are going in the direction that you want for bullish position, whether it's a covered call, a married put, a standard collar, what have you. You could buy a put to mitigate further losses. This would be if you expect negative earnings right now, but you still want to be in a long-term hold. But buying a put to create a married put, looking here at the September 200 in the money put at about 1453, it's going to increase the cost basis, which in turn is going to increase your break even from 216 up to about 230. That's just at September expiration. But it doesn't repair the $20 loss that you have, unrealized, of course. Adding the cost basis here of 1453, but going 5 or 6 points in the money, so we're really only adding about $10 worth of true premium time value. The rest is intrinsic. So the risk goes up to 3,000 instead of the 2,000 unrealized. However, if it's a disastrous earnings and it falls down to 165 or 160, you can't lose more than that 13.2%. Right now, just liquidating, you'd have about a 9.7, 9.5% loss. Adding the put, you could lose as much as 13.2%, but you can't lose more than that in case of a disastrous outcome. Another idea is you can create a synthetic straddle by buying 2 puts against 100 shares. If you had 200 shares, you'd buy 4 puts. You could potentially profit in both directions, but now you're going to experience much higher costs, and you're going to need a much bigger movement to reach the lower break even. We see here it's down to 150 on this synthetic straddle position, or up as high as 239.85 if we bought 2 September at the money 195 puts for 1190 times 2. Sometimes this is a good play to use if you have a lower cost basis or an unrealized gain heading into earnings and you don't know the expectation. You won't add too much risk in the position. The max risk only occurs, of course, if the stock's trading right at the 195 put strike prices. So you lose value on both of them in that case. But if the stock moves up, the delta of the stock starts to cover the lowering delta of your 2 puts. And if it falls, the gain in the delta on the 2 puts is starting to counter the loss that you're taking. But you need a much wider movement in this case because it's still factoring in this case the unrealized loss on the position. Now, is there anything we can do if we're expecting negative, but we want cheaper alternatives instead of just paying the full amount of money to buy the put, or instead of buying 2 puts and having that high cost basis? We have talked in the past about, is it possible to use a bear put debit spread as a hedge against a stock position? Well, yes, of course it is. It's lower cost, than buying the put outright. Here I'm going to buy the same put, let's say the 16th of September, 195, but I'm going to sell the 190 to cut down the cost basis. The problem here is that it has a capped protection to the downside. And I didn't realize how bad this graph looked. This image looked, and I apologize for that, but I wanted to include the profit and loss here from power options. So we know that we have an unrealized loss of $20. If we did the bear put position, we have to add a debit into it, so the loss could go up to 2,300. That's essentially the debit we're paying into the position. But you see here, it's just a little plateau that only lasts to 190. You still have continued losses if it falls to 160 or 165. Sam adds the bear put is limited income. That's exactly right. That's why I don't like to use it as a hedge unless I'm only expecting a decline of maybe 4 or 5%. As a hedge against earnings, is it lower cost? Yes, but capped protection to the downside. Capped income you could get back if the earnings surprise is greater than what you expected. Well, then you didn't really hedge too much of it. Just that $1.80, $2, or $3 of the difference in strike prices minus the net debit. That's the risk of a bear put debit. It is lower cost, but again, capped protection. So if it's beyond it, it won't help you. Put ratio back spreads. Two ways to do this. Instead of selling two puts and buying one, a true ratio put spread for a credit, you could buy two puts and sell another one. This is done at a debit, but the idea is it might help hedge the position. What we're looking at here, option one, is buying two at the money 195 puts and selling one lower strike 190 put against the stock position. This would be a debit of $14. Again, this increases the upper break even to 230. It mitigates the loss to the downside if it really collapses to about 3,500 or so. I'm sorry, to about 3,000. My apologies. About the same as we saw with just doing the married put position. You don't have to worry about being assigned stock with the short put in this case because you essentially have that bear put debit spread we're looking at just with an extra put purchased. So you don't have to worry about the stock is protected, and the bear put debit is still in there as well. But we're taking almost a 20% risk on the position now. If we did the opposite, if we sold a 195 and then bought two 190s, you reverse the ratio put back spread, you might take a risk of up to 20% if the stock's trading below 190, and I don't think that's an approach that you'd want to use in this case. So those are some ideas of what you could do in the position, depending on whether you're expecting a bullish move, whether you're expecting a bearish move due to the earnings, positive earnings, I should say, or negative earnings as well. We're down about 10% on a stock. Earnings are coming up. Those are some ideas. What would you do? Let's just take, I'm just curious. I just want to see what everyone thinks here. And it's not all of the answers. So if you have a different idea, go ahead. That's what the comments are for. Go ahead and send those in. And we'll look at that. But stock is down 10%. It sounds like Khokon is more leaning towards a longer-term hold on the position. Would you exit the position now, take the 10% loss, look to make it back later? Do nothing. Wait and hope, and then reevaluate the position after earnings. Would you look to sell a call as a simple hedge, hoping to get back to break even, or evaluate the stock repair on the position? Would you add a put to hedge further losses if the unexpected happens, which is always a good idea? You know I'm going to say that, but it's going to increase the cost basis on the position and increase the break even if you do have the positive earnings that you want. Or would you consider one of those elaborate synthetic straddles, bear put or put ratio back spreads, even though that synthetic straddle buying two increased the cost basis the most? So you have a very high upper break even, and you need a steep decline. It was almost down to 150 to hit the lower break even. Of course, these were just some basic ideas as a review. We could compare shorter term next week outputs that might be a little bit cheaper, but we know we're going to experience a lot of the implied volatility crush after the earnings on crowd comes out on, was it Tuesday or Wednesday? I forget, after market there. So something to consider. So let me know your thoughts. We've had the poll open for a little bit over just about a minute. I'm going to leave it open for another 30 or 40 seconds. So just let me know your thoughts, and then we'll share it. And then we'll move on unless there's any comments that have come in related to that. All right. 20% want to play it safe, and I have no problem with that at all. Exit the position, realize that about 10% loss, look for better stocks to make it back later, or hey, maybe even re-enter this position if the earnings are positive and there's positive outlook going forward, which not a lot of companies have been saying. Crowd's much different, of course, than the retail market would have been slashing their outlooks. But again, I like it, 20%. This is fantastic. No one said do nothing, wait and hope. We're going to take action. That's fantastic. Hey, that's why we're options investors. We have all these options to do something to help us hedge positions, help us hedge losses, help protect positions. We're going to take action. That's who we are as options investors. We're not just sit idly by. I like it. 20%. Sell a call or evaluate the stock repair just to get back to break even although we still might realize further losses. 40%, very conservative. Add a put, hedge to the position to hedge against further losses, knowing that, hey, if it does what I want and it goes up, I at least control the loss, and now it's going in the direction I want, so I can make back that put cost with other adjustments, income methods, and so forth, as we call them going forward. 20% say they might consider that elaborate synthetic straddle or strangle, bear put debit spread, or put ratio call spread. So thank you, everyone, for your feedback. I like it. I really like the fact that we see 0% and do nothing, because as options traders, we're always looking to do something one way or the other, to hedge, to increase profits, and to do more. Fantastic. All right, so let's go ahead and hide that poll there, and let's move on to our live positions. That's all I had for Khokon. So Khokon, I hope that helps out with some ideas. Of course, you'll be able to review this later when we post the archive. And that's just some general ideas, similar to the email I sent you, but a little bit more in depth, Khokon, related to what we were talking about.